Dr. Cheryl Dunn, and the purpose of this demonstration is to show making adjusting entries from an unadjusted trial balance. So take a minute to look at the problem that you're given. Now you'll notice that I took that unadjusted trial balance and instead of showing it as a list, I showed it as a set of T accounts that's labeled as the general ledger. And that's to show, that's so that we'll be able to show the posting of our adjusting entries into the accounts so that we can see the ending balances, because the questions that you're asked, the first question asks you to make the adjusting entries. The second question asks you what revenue and expense amounts you should be reporting on the company's income statement at the end for the year that we're accounting for. And the third question asks what the different asset and liability balances should be reported on the company's balance sheet. In order to answer those questions, it's helpful to post the entries into the general ledger so that we can see the ending balances to put on those statements. So that's why I put it in this format instead of the list as you were given in the question itself. All right, so we take the information that's in the unadjusted trial balance together with the additional information that you were given at the end of that list of accounts. So at the end of the trial balance, you were given some additional information. The first piece of information that you're given is what you have left in supplies. And so we can see that we have a supplies balance here of $5,640. We don't know how much of that balance was what they started the year with and how much was added in additional purchases during the year. Perhaps they had $1,100 to start with, and they then added supplies of another $4,540. We're not sure. Sometimes you're given questions for supplies expense where they give you the beginning supplies balance and then how many more were purchased, and then they tell you what the count at the end of the year reveals. In this case, the beginning and the purchases during the year are all lumped into one number that's on our unadjusted trial balance, because those purchases of supplies would have been captured during the regular accounting period as a regular journal entry. So they're already encompassed in that unadjusted trial balance number. They do give us what the account revealed. So somebody went out and counted the supplies and applied a cost value to them and said, oh, what we have really remaining is $1,220. Well, right now, our supplies account on our balance sheet would be reflecting $5,640 if we were to make the balance sheet today from these accounts. We don't want that to be our ending balance in supplies. We want the supplies account on our balance sheet to reflect the actual supplies that we have left. And therefore, we need to take away the supplies that have been used up. And so down here in some extra space, I'm going to say, for our supplies, we're going to look at that $5,640. We're going to take away from that the amount that we actually have left, which was given to us as $1,220. And that means we're going to have to make an adjusting entry that's going to take away $4,420 from this supplies asset account. And we're going to do that by making an entry that's going to take that, these were the portion that were used up, and that portion that was used up, we need to record as expense. So our first adjusting journal entry on December 31st is going to be to debit an account called supplies expense for the $4,420, and we're going to credit supplies the asset for that same amount. Now keep in mind that this supplies the expense represents the supplies that were used up during this year, and supplies the asset represents how much supplies we actually have on hand. And so by debiting the expense, we're increasing the expense, which is going to have the effect of reducing our net income, and by crediting the supplies, we're decreasing the supplies. When we post this journal entry into the general ledger, we're going to debit the supplies expense, and if we look at our list of accounts, we realize we don't have a supplies expense account showing, and that's because on this company's chart of accounts, they might have had a supplies expense account, but on the trial balance, it had a zero. When we have accounts that have zero balances, they don't show up on a trial balance. So we're going to add the expense in there, and it simply means they haven't recorded any supplies expense yet this year, is why it's not having a balance. And we would expect that, given that we're at the end of the year and now's the time to make the adjusting entries. And when they purchased those supplies, they would have recorded them as the asset. So now we're going to debit that supplies expense for the $44.20, posting from here, and then we're going to post this credit to supplies of $44.20. That will then have the effect of showing the correct ending balance in our supplies account, which is that $1,220. So the answer to part 1, we would have one adjusting journal entry that would look like that, and as part of our answer to part 3, we would have a supplies asset balance of $1,220, and as part of our answer to part 2, we would have $4,420 as our supplies expense. Another piece of information that you are given in this information after the unadjusted trial balance is about the prepaid insurance. And it says that your prepaid insurance of $4,800 was for 16 months. So that's this account right here. That $4,800 was for 16 months beginning January 1st. Well, since January 1st, now 12 months have gone by. If we break that $4,800 down on a monthly basis, $4,800 divided by 16 months is $300 per month. And so now 12 months have passed. That means 12 times 300, which is $3,600, needs to be taken away from this asset and recorded instead as insurance expense. And so we would make an entry, an adjusting journal entry, on 12/31, we would debit insurance expense for the portion of this policy that has been used up, and we would credit the prepaid insurance for that same amount. And again, that's 12 months worth of insurance at $300 per month that has not yet been recorded as expense, and so it needs to be recorded as expense, and it needs to reduce the value of this asset that right now is overstated. If we look at the expense accounts on our list, we notice again that we don't have any insurance expense on here, and that's because we haven't recorded any insurance expense yet. It doesn't mean we haven't incurred any. We just didn't record it because we had put it on as an asset. And so we're going to add insurance expense here as an account in our general ledger. And again, it might have already been in our general ledger, it just wasn't on our trial balance because it had a zero balance to start with. So now we're going to post this debit into the insurance expense account for $3,600, and we're going to credit the prepaid insurance by that same amount of $3,600. What that's going to leave us with then is we will show an ending balance in the prepaid insurance account of $1,200. Now let's ask ourselves if that balance makes sense. We'll mark that we posted both parts of that entry. What we should see in our prepaid insurance asset account is the remaining months of our insurance policy that we have left that are not used up. And since the $4,800 paid for 16 months and it was paid for January 1st, we're now at December 31st, that means we should have 4 remaining months because 12 have gone by. And at $300 a month, 4 months times $300 is $1,200, which is now what that asset balance will reflect. And so that makes us happy. The third piece of information you're given is pertaining to prepaid rent. Our prepaid rent number down here of $12,000, it says that paid for a lease that began on February 1st. And so we look and say, okay, that $12,000, if that was for 12 months beginning February 1st, that means now 11 of those months have gone by. And so we only have 1 month remaining that we haven't used whatever it was that we were renting. And so we need to now decrease this asset so that it only represents 1 month worth of prepaid rent, and we need to record rent expense for the remainder. Now if we look at our expense accounts, we see that we actually do have a rent expense account. That's probably $980 was probably the rent for January that we paid in a previous lease when we paid that. And so then February 1st we had a new lease that started. It looks like the rent probably went up a little bit from $980 to $1,000 per month. That $12,000 divided by 12 months would give us $1,000 per month. So it looks like we had a slight increase in rent. Well, now we need to record the expense for the rent that we actually used up. So here again on December 31st, we're going to debit rent expense for the portion of that prepayment that has been used up, which is 11 months worth, 11 months times $1,000 per month. And we're going to credit that prepaid rent asset for that same amount. If we post our journal entry, we post the debit of $11,000 to rent expense. That increases the balance of rent expense to $11,980, which is about what we would expect it to be, with that being January and that being the other 11 months. That brings us to almost the $12,000. And it looks like a reasonable rent expense if our rent is approximately $1,000 a month. And then we credit the prepaid rent for $11,000. And that leaves us with a remaining balance in that prepaid rent asset account of $1,000, representing again approximately 1 month worth of rent. And that should make sense to us as well. So if you were answering questions 1, 2, and 3 with respect to rent expense and prepaid rent, this would be the adjusting journal entry that we would record at the end of December, assuming that we haven't made any adjusting entries during the year, which it told us, and we make annual financial statements on December 31st. So this is our adjusting entry. Once that adjusting entry gets posted into our system, we end up showing rent expense for Part 3 on our income statement, for Part 2 on our income statement of $11,980. And for Part 3, the asset account on our balance sheet would reflect the balance of $1,000. Okay, next you're given information about your equipment and the depreciation method that the company uses. It says the company uses straight line depreciation, which means it takes the depreciable cost and divides it evenly or spreads it out evenly across the asset's life. It tells us the equipment has a life of 5 years, and so we're going to take that $34,000 cost of the equipment and we're going to subtract the salvage value, because the salvage value is not part of the depreciable cost. We expect to recapture that from selling the asset when we're done using it. And so that's not a cost to us. So the difference of $32,000 is what we're spreading over the 5-year life. And if we do the division here, that would end up being $6,400 per year. Okay, and it tells us that we bought that equipment 3 years ago on January 1st. And if we look at the accumulated depreciation account on the equipment, that makes sense, because this represents basically 2 years worth of depreciation, because if you take that $6,400 and you multiply it by 2, you would get that $12,800 as the amount that we have already allocated. Okay, next, if we look at our list of expenses, we don't see depreciation expense on there. We're going to add that one. Again, they probably had it in their general ledger and on their chart of accounts, but because they hadn't recorded any depreciation expense yet this year, it would have a 0 balance. And so it did not appear on the unadjusted trial balance. Now that we're making the adjusting entries, we need to record what portion of this equipment's cost needs to be allocated to the current year as expense, and therefore reducing the net balance of the equipment. To get the net balance of equipment, you take the debit balance in the equipment account, which we don't change until we actually sell the equipment, then we'll take it out of there. But instead of directly reducing the equipment account, we do it by the use of this contra asset called accumulated depreciation on equipment. And so the net value right here represents basically 3 years of unallocated cost or undepreciated cost. We need it to represent 2 years because 3 years have gone by now. There's 2 years left. And so we need to reduce this net value by that amount of $6,400 representing the portion that's allocated to the third year. In order to do that, we're going to make an adjusting journal entry over here. That's going to debit depreciation expense for the amount of $6,400, and we're going to credit that accumulated depreciation on equipment for that same amount. We post the first part of our entry as a debit to depreciation expense, and then we post the credit side of our entry to that accumulated depreciation account. That brings the balance in the accumulated depreciation to $19,200, which represents 3 years worth of depreciation, which is what we wanted. There's 2 years remaining undepreciated cost value left in the equipment. That's going to be the net asset value, and the expense represents 1 year worth, which is what we want on an income statement because it only represents the depreciation that should happen between January 1st and December 31st, whereas the accumulated depreciation should represent how many years of the asset is used up. And so that's representing the fact that 3 years have gone by since we bought that equipment. And that's what we want to happen. So our answer to part 1 with respect to the equipment, it would be we would debit depreciation expense and credit accumulated depreciation as our adjusting entry. The entry for part 2 that asks for our income statement account is that we would have depreciation expense of $6,400. And the question for part 3 where they ask about our asset values, our equipment value would stay $3,400, but the accumulated depreciation would raise to $19,200 so that the overall net value of that equipment has gone down because the contra asset reduces the asset on our balance sheet. Okay, next we're given information about the fact that some of this unearned revenue here has actually been earned. They tell us that $4,200 of this $6,780 has actually been earned. Unearned revenue represents a liability account. It means that we owe our customers the amount of that as some kind of a service or whatever kind of revenue we have. In this case, it is service revenue because if we look at our revenue account, that's what it's called. So we owe our customers services worth $6,780, or at least we did according to our unadjusted trial balance. But our additional information now tells us that, oh, wait, we've earned some of that. That means the liability right now is overstated, and we need to lower it to the amount that we actually still owe to our customers. So in order to reduce that, we're going to recognize the revenue, because if we don't owe them the services anymore, that's because we provided the services. Just because we haven't done the paperwork and actually taken that as earned revenue yet, that doesn't mean that we haven't actually earned it. This is additional information is saying that we did earn it, and therefore we need to debit that liability to reduce it, because liabilities normally have a credit balance. In order to reduce them, we debit them. So we're going to debit the unearned revenue for the amount that we actually have earned, and we're going to credit the service revenue account, which will increase our service revenue, which is what we want to happen. When we post that journal entry then, we're going to debit the unearned revenue, which was here, and that will bring the balance in that unearned revenue account to $2,580. That's the amount of service that we owe our customers now. So that's a better reflection of our reality. And then we're going to credit the revenue account for $4,200. That will bring our overall revenue for the year to $60,800. Again, better reflecting what has actually occurred in this company. And so we check mark to indicate that we posted both sides of that entry. Our answer to part 1 with respect to unearned and earned revenue is that this is our journal entry we would need, our adjusting journal entry. When we post that, that gives us the answers to parts 2 and 3. So part 2 for the income statement, we would want our service revenue account to reflect this $60,800. And for part 3, for the asset and liability accounts, we would want this liability account called unearned revenue to reflect this amount of $2,580. Also given information about wages. It tells us that the workers have worked additional time since the last payday before the end of the year. They've earned another $2,970. And so that's an example of an accrued liability. So we need to record the fact that we have incurred an expense of that time worked. So we're going to debit wages and salaries expense for that additional $2,970, and we're going to credit a liability called wages and salaries payable for that same amount. We go to it, post our journal entry then, we debit the wages and salaries expense, which is this account right here. I just abbreviated it from what was on the trial balance because I couldn't fit wages and salaries expense, but this is the same account. And so I'm going to debit that for $2,970, which is going to give us a total wages and salaries expense of $35,070. That's the amount we want to reflect on our income statement as an expense for the year. And then wages and salaries payable, if we look at our list of liabilities, notice we don't have a wages and salaries payable account. Again, there might have been one on the chart of accounts and in the general ledger. We just didn't show a balance for it, and so it didn't appear on our trial balance. So we'll go ahead and add it here. And we're going to shorten it to just wages payable, again, because I just don't have room. And that's going to reflect the $2,970 that the company now owes its employees for the work they've done since the last payday, but before the end of this accounting period, which is the calendar year. When they then pay the payroll in the first couple weeks of the next year, they will debit this liability to get rid of it. They'll debit wages and salaries expense for the following year, which will have gone to zero once our closing entries are made. And so then in that next calendar year, the portion that was worked during January will be reflected, whereas this last little bit of December is now reflected in this year's wages and salaries expense, which is what we want. So for that one, for part 1, if we were asked for the adjusting journal entry, this would be our answer. If we were asked what should be the balance for wages expense on the income statement, we would give the total of $35,070. If we were asked what liability should be reflected on our balance sheet with respect to wages, we would say that should be wages and salaries payable, a balance of $2,970. Thank you for viewing this demonstration. I hope you found it helpful.